the fuel is the questionable part, but I think thus far it's been the what people are referring to as the pivot from the Fed. And essentially, Mr. Powell from about 4 months ago signaling that we had automatic pilot for the quantitative tightening program. We're going to continue to raise rates. Everything was great to the big pivot, not only at the beginning of January, the January Fed meeting, and then going even more dovish when it came to the March meeting, where not only did he signal that the rates will stay on hold the rest of the year, but also the unwinding of the balance sheet will cease to continue by the fourth quarter of this year. So ultimately, it's the Fed put, I think, that's been in play here, which has not just benefited the stock market, but risk assets in general across the U.S. markets.
So we've seen the move, Jeffrey, and we're now within, I don't know, 1% of a record high on stocks, the 10-year yield in the 250s. I mean, where's the opportunity right now?
Well, it's tough because essentially you are where you were roughly as we went into the fourth quarter before essentially there was a self-inflicted wound by the Fed, just ignoring some of the signs that were coming from the weakness in the global market. And so you have to step back and ask yourself, do you feel better about the economy today and where we are in the cycle than you did roughly 6.5 months ago? And so, as you mentioned, stocks are near their highs. They're actually at a new high if you include the dividends reinvested. But what you have that's different is essentially 10-year yields are roughly 50 to 60 basis points lower than they were as we went to the fourth quarter of last year. And so really the only thing that's changed outside of the volatility is yields in the Treasury market are slightly lower. So as we look across the board, one of the more attractive areas across the fixed income sectors happens to be emerging market debt. And a lot of the troubles and tribulations that get attributed to the emerging market space are the strength of the dollar, which the dollar has been extremely range bound this year and really just can't break this new high in levels. It's roughly about 0.5% or 75 basis points off the highs. And so we think that's still an accretive area to be where it has a better spread opportunity, we think, than comparable U.S. corporate credit, both in the investment grade as well as the below investment grade parts of the market.